Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. This podcast is brought to you by Exern. With Exern, you can easily deploy AI models to extract sentiment and insights from textual data, such as the news, financial filings, and more, in real time and without writing a single line of code. Exern's models are pre-trained for finance, so you get more accurate investment signals while cutting down time to deploy from weeks to minutes. Get started with your free 1-month trial now at meet.exern.com/podcast. Without further delay, let's jump into today's episode. I'm so excited about today's podcast episode. We are welcoming Paul Rowady, who is the Director of Research at Alphacution Research Conservatory. This is his second appearance on the podcast, and Paul is one of the brightest minds around capital markets, exchanges, and market structure. So I'm really excited to have him on the show. Welcome, Paul.
Lex, it's really great to be here, and I can't believe it's been almost a year. We had such a great conversation the first time around. It's a real pleasure to find time to get together again and have a chat.
And it's been an insane year at that. I think, last time we talked and thought about like Robinhood and market makers and equity market structure, and you fast forward 10 months, 12 months, and now Robinhood has 20 million monthly users, 100 billion of assets under custody, of which 20 billion is crypto, 500 million in quarterly revenue, and then 40 billion or so in market cap because they've gone public. And of course, 30 billion of that, I think, evaporated over the last few weeks. What have you seen? What have you looked at as it relates to Robinhood? What are some initial thoughts on their journey over the last 12 months?
It has been an amazing journey for them and the markets and this new demographic that has joined the community of traders and investors, where Robinhood has created a portal to U.S. markets for a younger cohort of the investing community, at least in the U.S. So that's significant. But I think based on a major piece of research, the most ambitious piece of research we've done to date, which ultimately was titled The Robinhood Effect and published in late July, which assimilated regulatory data and other disclosures on 25 entities that make up the retail, brokerage, and wholesaling side of that equation. And the bottom line of the whole thing is that Robinhood created a portal to U.S. markets that elevated trading velocity by an order of magnitude, 1 to 2 orders of magnitude, depending on whether you're talking cash equities or options. So having a mobile first and social media enhanced mechanism, and certainly payment for order flow and a zero commission framework, that changed everything and allowed new players in the market to trade beyond the velocities that we had seen in the recent past with the likes of TD Ameritrade, E-Trade, and others.
What is trading velocity? What does that mean?
It's a measure of what's the average number of trades that a client of one of these platforms will make over some period, a month, a year, so forth. So there's some data I put out on our feed on the Alphacution website that does this comparison between Robinhood, TD, E-Trade, and Schwab from Q1 2020, which was the last time all those entities were independent. And we had a look at the right pieces of data to generate a metric like that says, on average, how often do clients of these various platforms trade? And in the case of Robinhood, it was a magnitude beyond Schwab, 100 times Schwab in terms of options. I mean, it really was beyond anything we had ever seen. And this is partially what's causing this massive market freak out over how much retail order flow is in the total volume in US markets.
Yeah, I mean, I have some data here just around Schwab of annualized trades per brokerage account. And I mean, there's something in the water, separate and apart from Robinhood and its blinking lights. The number of trades per account went from something like 10 to 60 or 70 per year for a regular user, and that's just on Schwab over the last year. So digital finance is full of neurosis and anxiety for the average person, and then you lever that up again on Robinhood, and you get to a fairly active population, I guess.
It's an incredibly active population. Certainly the zero commission framework is the sort of the gateway drug to this massive explosion in trading velocity on all the platforms. But because Robinhood was designed mobile first, I think that they have an edge even over the TDs and E-Trades, which are quite innovative in terms of the technology. But designing something that operates from a phone as an initial vision really puts them at the forefront of exploiting what it means to be able to trade, A, with the zero commission free framework, and B, with little or no account minimums. So, you graduate from high school, your grandmother gives you $500, it pops it into a Robinhood account, and away you go trading Tesla options all day.
The dream. So when you were doing these analyses last year, the story about the composition of the revenue, the contribution of options trading and the beginnings of the contribution of crypto trading was kind of emerging. And ever since the company's gone public, that seems to have shifted more and more, especially as they listed Dogecoin and so on. Can you talk a little bit about what you see in the composition of the revenue and the drivers of the company's money-making machine?
Well, a couple things. It initially, when the data first started coming out in Q1 of 2020, there was an enhancement made to a regulatory report known as the 606 report. And historically, that report showed the percentage of orders that went to various brokers, various market makers, various liquidity venues. 5% goes to the New York Stock Exchange, and 10% goes to IEX, and 20% goes to Citadel, et cetera, et cetera. And then in Q1 2020, the dollars were associated and the rates. So for the first time, we started to see what the rate paid for market orders to each venue and what that added up to. And so if you took the time to meticulously go through all these reports and add it all up, you could see the market share of the wholesaler and the market share of the retailer, and ultimately see that this was a story really about options because the rates were higher. The rates being driven largely by the liquidity of the security, the underlying security. It's a separate conversation if we want to go down that road, but there's what I believe is a governing liquidity economics framework. It's not that Robinhood gets to make up the rates that their wholesalers are paying them. It's that order flow based on the order type and the order size and the underlying security all converge to create a framework on what that payment should be for the order. And so we found that really most of the payment for order flow was a result of options trading, which makes sense because you don't have to pay the full price to trade, Tesla at $800 or Amazon at wherever it is now. You can buy or sell a $10 option, and that's very easy to do economically when you just put, a few $100 in a Robinhood account. So that development on the regulatory side in early 2020, that, oh, by the way, coincided with the pandemic lockdown and all of the new trading that occurred as a result of people being at home, really created a phenomenon in the market that impacted both, either directly or indirectly, pretty much everybody in the ecosystem. Is a significant development. Now, flash forward a bit, and I know we're going to skip over a lot, but flash forward to Robinhood's latest earnings report, and we see this massive shift toward crypto trading and the revenue of that crypto trading. But oh, guess what? A lot of the same wholesalers or group of wholesalers are still behind the scenes. We have a few new names. One that you're likely to be hearing about, certainly by Alphacution, we've already written about it, is another very successful, legendary proprietary trading firm called Jump Trading, based in Chicago. And in Q2, they paid more for crypto orders to Robinhood. They paid more to Robinhood for that order flow in cryptocurrencies than Citadel Securities had ever paid for equities or options. It was $163 million in one quarter by one player. That's a significant development.
That's pretty incredible.
Really incredible. And what's also incredible is that there's no paper trail. It's only because I'm able to do some contextual modeling and read, the footnotes and make some judgments between the lines, that since I'm already following this secretive world of proprietary trading firms who happen to be some of the largest market makers and wholesalers in the world, I've been able to jump into this space and have something new and informative and sometimes quite detailed to say. But the regulators are way behind. There's no 606 equivalent for crypto trading. So we're not going to get, a report somewhere at some point that says Robinhood allocated such and such of its crypto order flow to this player and such and such to that player. And oh, by the way, this is the rate on average that they paid. We have none of that. We just have some of the chunky figures, and they're rather astounding.
Yeah, there's so much to say on this, and I think it's a couple of interesting points. The first is that crypto has a lot of market makers, and the ones that are on chain, especially around DeFi, are transparent. Like you can get the dashboards for all the volume and all the fees paid out and charged and so on in an instant, mark to market all the time. But for firms that are structured like Robinhood, or maybe like a PayPal or a Square, where they're going to be working with a third party to provide the crypto side of the equation, that's just contracts between private companies. And so, like you mentioned, there's a footnote to Jump in the disclosure, and it's pretty fantastic to see, because Robinhood's business is sort of drifting from this traditional notion of a stockbroker to really a trader or a speculator on the zeitgeist, on memes, on what people believe in. And not only are you turning over lots of shares more quickly, but you're likely doing that through derivatives and through the leverage that comes in that instrument, and then potentially disconnecting entirely from operating companies and focusing on crypto, and especially meme crypto like Doge. So there's a really, I think, secular change in terms of what Robinhood represents. But if we just put some definitions back into the conversation, when you say wholesaler, what does that mean from your perspective?
That is a specific kind of market maker that is accepting orders, whatever orders come in a particular security from the retailer. So rather than the retail broker sending orders directly to, say in this case, a public exchange, it's sending those orders to an intermediary in order to receive a payment. That payment is occurring in lieu of commissions. It's the mechanism that allows for the zero commission framework. So the wholesaler is an intermediary that will accept a large block of order flow, I guess is the simple way. The nuance, though, is that wholesaler is trading against that order flow privately in the dark market. So there's a very heated debate about best execution and the fact that this retail order flow is not part of the tape, so to speak. It's not represented in the flow of bids and offers in the consolidated market for any of the US securities that are being traded. So that pretty significant piece of the debate. I hope I answered the question about wholesaler, but we can go into more detail.
And one analogy that I've carried from our prior conversation was really thinking about like payment for order flow doesn't have to be, it's not necessarily a nefarious thing. It's kind of it's like a marketing cost, like a cost of customer acquisition for the wholesaler, which is, purchasing this economic activity. But then, of course, they're making money on the other side, sometimes 4, 5, 10 times the amount, and they need this liquidity as an ingredient into their core business. Is that roughly right in terms of how to think about it?
It's absolutely right. And in fact, it's become a competitive necessity. And at least it appears that way. And I believe that that's the case. The evidence suggesting that for these proprietary trading firms to be successful in usually they're very highly automated, what I call hyperactive trading strategies, what most people call high frequency trading. You've seen in the announcements, for instance, by Hudson River Trading that they were going to get into the retail wholesale game. You also heard shortly thereafter from Jump that they were also looking at getting into the retail wholesaler game in 2022. And to me, these are indications that in order for these proprietary trading firms' core strategies to remain profitable, they can only do so by harnessing some component of captive private order flow. In other words, to get a first look at the order flow and then arbitrage dark liquidity with lit liquidity. But it's a race to the bottom, because the more flow that leaves the public markets, the more toxic those public markets become. It just becomes institutional order flow that's trading against hyperactive trading strategies, which puts them at a disadvantage. But it seems like the entryway to a funnel, this captive retail order flow, is part of a cascading series of moves for proprietary trading firms to be successful. And that if you don't have some wholesaling arrangement with the retail broker, that you're missing a piece of the edge that makes all the downstream components work profitably. And that's a significant development, significant and frankly a worrisome development, that this market mechanism has become so twisted that you have to trade in the dark with captive order flow in order to harvest, some kind of structural alpha from the ecosystem. That's pretty crazy.
That's super bizarre and quite non-obvious, right? So play it back to you. What I'm hearing is that there's almost like an insurance industry lemons problem, right? Where insurance works if all the good risks and all the bad risks are in the same pool, and we a priori don't know what outcome we're going to get, and so everybody pools some sort of premium, and then the distribution's random, and whoever gets hurt gets the insurance payout. But if you know beforehand who the bad risks and the good risks are, you can't really have insurance, because the only insured or the only people who want insurance are the ones who are the bad risks, and all the good risks are just walking off with their own luck. And what you're describing here is that, in a sense, a large market maker that's able to pull out retail liquidity, retail trading from the kind of the lit markets, the traditional markets, and have that to the side. In essence, when they're interacting with the traditional markets are worse off. They're kind of broken because they don't have, I guess, this normal activity in it.
Yeah, they don't have the benefit of that order flow or pricing. So there are nuances in the rules, and this is where Robinhood comes back into the picture, because Reg NMS, the regulation established in 2005 that gets to the rules around best execution and tries to consolidate a national best bid and offer per security, given the fragmentation of liquidity across numerous, public exchanges and multilateral trading facilities, alternative trading systems. All this fragmentation gets brought back together to say, okay, what's the best bid and what's the best offer right now? But interestingly, that rule does not apply to odd lots. So odd lots are any order that's less than 100 shares. Well, guess what Robinhood traffics in? It's all about the odd lots. In fact, it's all about one lots as far as I can tell, right? Because you have such a small average account size at Robinhood. It's just a few $1,000s as compared to E-Trade and Schwab and TD, which is, $100, $200, $300,000 on average per brokerage account at those what have become perhaps more mainstream retail brokerage platforms and trading platforms. Robinhood's in an entirely different category. These are tiny, millions of tiny little accounts. So it's trafficking in odd lots, if not one lots. And all of that, per the rules, doesn't even hit the tape. It's hidden liquidity. And this is the aspect of the liquidity that makes it so valuable, and why, in the context of a governing liquidity economics framework, a one lot will receive the highest per share payment for order flow rate, because the wholesaler can do pretty much whatever the hell it wants with that order.
That is such an interesting and strange externality of venture capital trying to make some mobile apps for trading.
It's crazy. And I think really they saw this opportunity early on. And you bring it up, the venture-backed entity Robinhood, they made it their mission. They were very aggressive about building a mechanism that could exploit these nuances. I mean, the founders of Robinhood, are not long after their undergraduate education at Stanford, when in 2013, I think they founded Kronos. I think it was a research operation, turnkey, high frequency trading platforms that ultimately, just 2 years beyond that, morphed into the first version of Robinhood in early 2015 and their early seed round of $3 million of venture capital to begin that journey. They were very aggressive about building this thing a certain way. And the fact that you can bring all these new players in with such small pieces of money to trade in ways that's essentially hidden from the broader market, and yet bring so many of them together, like a crowdsource all these tiny little trades to influence the entire market. I mean, the proportion of retail order flow at the end of 2020 was 28% of total volume, which was about a doubling from around January of 2020. I mean, this is how significant. So this order flow, which is crazy order flow, impacts everybody downstream: hedge funds, ETF providers, traditional asset managers, pension funds, everybody else downfield. You think of it as the food supply. Everybody that's trying to get alpha nutrition downfield from those that are standing close to the sources of liquidity, the market makers. Everybody else is scratching their head wondering why don't our models work anymore? And it's because that the nature of the flow had changed so dramatically, as if someone had, poisoned the water.
Can you open that up a little bit in the sense of what is the impact on the downstream asset managers and hedge funds? Outside of the more kind of obvious meme stock weirdness, what is happening to the normal model of investment management?
Well, this is something that Alphacution's been tracking really since the beginning, and I've referred to it as the barbelling of the asset management ecosystem, between the privatization of alpha capture on the one hand, which is proprietary trading firms, market makers, high frequency trading strategies, those that really stand very, very close to the sources of liquidity in many ways, are often broker dealers, market makers, the high frequency gang. And then at the entire other end of the ecosystem, you have all the money flowing into ETFs, which is the passive management zone, because people have said, I don't understand the fundamentals. The market doesn't react in ways that I understand anymore. I try and pick value when it's out of favor and hope I can make excess returns. And essentially the discretionary strategies that worked over decades stopped working. And so fees became compressed, discretionary strategies lost favor. There was a rotation of assets into passive management vehicles. And so you have an ecosystem where a ton of money is either flown into the passive end, and a ton of the profits, not necessarily the money, because there's limited capacity at the high frequency end, what I call the structural alpha zone. A lot of the theoretical alpha is being captured by these highly sophisticated players that stand real close to the sources of liquidity. And then everything in between the active management zone is essentially the hedge fund community. And it's really only the top quantitative players that are working with very sophisticated, what is now known as mid-frequency strategies, what formerly might be called statistical arbitrage. The D.E. Shaws, the Two Sigmas, in some cases, Renaissance and Bridgewater and a few others are harvesting the alpha that is currently not being captured by the Citadels and Susquehannas and Jane Streets that have such massive technological firepower that they're catching alpha that nobody ever caught before. It's like catching a 100-mile-an-hour fastball with regularity coming off the bat. Right, that you would rarely catch all of those. And now the technology is such that there are players that can catch this and capture theoretical alpha that used to linger and exist in the ecosystem long enough for a number of different species of traders and asset managers to capture it. Now it's being captured systematically by an arsenal that's owned by just a few players. I hope that makes that barbelling imagery make sense to you.
Yeah, it's it's very, very vivid. So Gary Gensler from the SEC has feelings, emotions, and thoughts about this space. And the last couple of months have been the SEC trying to establish jurisdiction over a bunch of things that don't really want the SEC's involvement, such as certain crypto assets, but also payment for order flow, right? It's not a model that's really done in Europe. It is unique to the US. And so the SEC's, let's say, digging in. What do you think are some potential paths for regulatory action, or sort of what are the different versions of the universe that could happen here?
Well, just as a asterisk on something you just said, the practice of payment for order flow has been banned in Europe, Canada, and Australia. So these markets have said it's a conflict of interest that we'd rather not have. You can't do it. And the US has not said that, at least not yet. So we certainly, because of all the publicity around zero commission framework, Robinhood's success in developing a very aggressive new model that can harness the practice of payment for order flow and other aspects, they're kind of forced to at least do a performance of saber rattling, right? Because the profitability is astounding. The question is, does the bark have any bite to it? And so that's question number one. And if the bark has a bite to it, how long does that bite take to sink in? Because we've seen the SEC do saber rattling to varying degrees, depending on the tone and tenor of the atmosphere. But, they're fighting a lot of old battles. Some of the fines that we saw with the likes of, there was one a year or two ago, $65 million for some kind of spoofing activity at Tower Research Capital, which is one of the big, powerful, legendary high-frequency trading shops, and $65 million fee against the billions in net trading income that they've made doesn't seem like it causes much of a dent or prevents much. So I'm skeptical. We're in the saber rattling stage. But it's certainly on the table that payment for order flow is a mechanism that has become too hot, too toxic to let it continue. But the fact that it's connected to this captive, private, dark market, and that the dark liquidity has become as big as the lit liquidity. Dark markets have become half of the total volume at the peak. And that just means that all that liquidity is kind of being executed off book. And really, I think that the constituency that ends up paying for that indirectly is the institutional asset managers, because they don't have access to that order flow. And as a result, what you hear is price improvement by the likes of Virtue Financial CEO going out and saying payment for order flow is great. And that we offer, all this price improvement, so-called price improvement to the clients of retail brokers or the orders of retail brokers. That price improvement is actually being paid by institutional asset managers by virtue of the lack of order flow, that the hidden liquidity that they miss. So there are a number of problems that are happening here at the same time. And it may be these indirect costs or intangible costs being borne by institutional asset managers that is one of the straws that breaks the proverbial camel's back in terms of banning or curtailing payment for order flow in the United States. And then it's a question of on what timeline.
It's fascinating stuff, and we've chewed through a lot of our time with really fascinating conversation. I wanted to just get one more question in for you, which is, you've done a deep dive on how this type of market structure, in other words, wholesaling and market making by institutional players, how it's starting to emerge around cryptocurrency trading and that ecosystem. Now, crypto is much earlier, and it's got different types of, or at least different ways that you can trade and swap, both in terms of different venues, on-chain, off-chain, permissioned versus decentralized. But there's an enormous amount of trading that's going on platforms like Robinhood, and I think increasingly that's going to be true for SoFi and Square and PayPal and the rest. So what do you see emerging that you're referring to as crypto wholesaling? What could that look like going forward?
I think that is the closest replication of the existing market structure in traditional products, cash equities and options. And there is call it, a gravitational pull or a magnetism to that market structure, because the trading firms that are the backbone of that market structure, or have the opportunity to become the backbone of that market structure ahead of an exchange structure, like you find in the US with the New York Stock Exchange and NASDAQ, et cetera, that it's only in the later stages of that traditional market structure that the alternative venues actually carve out some power in the ecosystem. With crypto, those power centers can happen earlier in the journey of the market. And so firms like Jane Street and Jump and DRW, all part of this community of highly automated, technologically savvy, really beyond belief, have stepped into this market early to try and gather up some of that, to become part of that power structure so that they can influence the ultimate market structure. And you don't really have to invent a whole lot new. The product is new, but the market structure is not. So it's just, the idea is that there's more grease on that skid. Whereas evangelizing not only a new product, but a new market structure, a new workflow, has extra, components to it where you have to evangelize and prove out the utility of an alternative market structure, which of course, that's kind of in the zeitgeist of the crypto world anyway. So you're going to have that, and it'll be a battle between the various market structure models. And in fact, that creates opportunity, that diversity and that decentralization between different workflows, different, market centers, different liquidity venues. It creates the kind of fragmentation and arbitrage opportunities that these big proprietary trading firms are looking for and trying to exploit in the first place. So it's truly the wild, wild west. And on top of it all, there's no spotlight. There's no regulatory requirement. There's no equivalent of a 606 or 605 report. There's no best execution requirement, other than the players like, say, a Coinbase that says you're going to get treated better if you trade here as opposed to somewhere else. And so there is a self-governing nature, even in a formative market structure. Even with all the apparent messiness, there will be some self-governing, because as institutional money comes into the crypto space, those fiduciaries are going to want to have some degree of confidence that they're not getting ripped off. If it sounds like an oxymoron, because some believe that, the product itself has an element of being ripped off, but that the process, you could get ripped off in the process, or pay too much to execute or to hold or to clear, or any of the components of the workflow.
Yeah, it's amazing how much there is beyond pushing the button and saying buy, on a website. And I think for our listeners to really feel that the value chain and understand the warp that's happening in the value chain is extremely valuable. And I think this kind of setup as well in the crypto world, between taking the traditional approach to market making and trading, which is more centralized, versus some of the more blockchain based and transparent approaches, which of course have their own concerns, is also an issue that's very existential. And although not a lot of people understand it, I think they should, because it's so key to their experience and their financial health. I want to thank you for spending the time with us today. If folks want to learn more about this research and become a subscriber or just follow you, where should they go?
Very easy. It's alphacution.com is the website, alphacution.com. And I'm at Alphacution on Twitter, and everything I post gets posted in parallel on Twitter, and pretty easy to find. Lex, it's really been, I enjoy our conversations. I hope it doesn't take us a year to get to the next one, because the world is changing so rapidly. It's really difficult to keep our minds wrapped around all that's happening. And really, we're scratching the surface of the conversation. There's a whole element of manufactured order flow through a mobile app that is a big topic, maybe worthy of a separate conversation in totality, that you can dial up certain types of order flow on demand because you're using social media techniques in a phone to determine, okay, what kind of orders do we need? Okay, let's set an alert and lay off a confetti bomb, and here we go, trade this. It's a whole new world out there, and we just need to strap in and strap on, and it's a wild ride for sure.
Yeah, we are so much more surrounded by robots that direct both our attention and our money than most folks realize. Thank you again so much for hopping on, and we will definitely do this again.
Thanks, Lex. Be well.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.